My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you some money. My job is not just to entertain, but to put everything in context. Call me, 1-800-743-CNBC. Tweet me at Jim Cramer. Hey, maybe that was the sell-off. Maybe things fell enough. Maybe they fell too much. And that's what I'm beginning to believe as I survey the sometimes massive destruction in stock prices that we've experienced in March and April. Of course, we have a glorious lack of big-picture economic information right now after getting some weaker labor numbers last week that could put the Fed on a course to cut interest rates. There's not much else macro ahead, at least not anytime soon. Oh, we got a couple of Fed officials lurking around, waiting to speak in public. There's some errant consumer confidence numbers on the way, not to mention worries about Disney's number just tomorrow. But otherwise, when you look at and survey today's action, Dow gaining 107 points, S&P jumping 1.03%, NASDAQ advancing 1.19%, you know we've now moved on to an aftermath of a pretty vicious sell-off. And any decline from here might be an occasion to buy. In other words, maybe the worst is behind us. Let's take the quintessential stock of the new year to be able to put this in context, okay? Let's take Nvidia. I want you to think of the Nvidia arc. The stock, which had been a rocket, started fizzling on March 8th. That's when it peaked, when we got a surprisingly strong employment report that made us feel like the Fed was foolish to take more rate hikes off the table. Remember that? So what's happened since then? Well, okay, so Nvidia introduced an incredibly revolutionary chip. It's called Blackwell. Far faster, not faster, but far faster than anything that's currently available. Put that in perspective. Let's say, I wanted to use an example just so you can always, it comes to life this way. Let's say you want to teach a robot to pitch in Major League Baseball. Well, right now, they'd be pulled in the first inning. But you show Blackwell, okay, the computer, videos of all the great pitchers. You load them in. Then you show Blackwell videos of all the great hitters. Load those in, or at least the hitters of a really good team. Blackwell can then tell the robot exactly what to pitch and where to place it. And the robot will get this. It will pitch a perfect game every single time. Every time. And that's just one example of how revolutionary this chip is. Blackwell can help figure out how all the major illnesses operate at a micro level because it can rapidly map and understand proteins. That used to be an insanely time-consuming course. Now, look, this does not mean a cure. Far from it, okay? I don't even want to suppose that. But it means that research can be accelerated, and that is often what really needs to happen. The Blackwell supercomputer offers an Omniverse product. That product can work with Apple Vision Pro to build something virtually so that you can perfect the design and then help execute it in reality with a fraction of the waste. And waste really matters these days. We saw it made me feel when I was in that Nissan Roadster, when I was actually just sitting in a chair. People are laughing at me about the power of the Vision Pro, and I get that. But you know what? I'm going to laugh last, not unlike Carrie in that great gym scene. Now, this technology can speed up any of the hyperscalers programs. Amazon, Alphabet, Meta, Microsoft all seem to want Blackwell chips, even if they are developing their own less powerful in-house semiconductors, which we hear about constantly, but they don't compete with what NVIDIA is doing. Blackwell may be the answer for so many problems that we don't even know exist yet because we aren't yet capable of imagining the solutions. Our brains really just aren't big enough. I know that sounds strange, but it's true. Things that used to take weeks to calculate can now be done in a day or an hour, so you'll do something that you might not have done otherwise. Now, you might think this would have been huge for NVIDIA, the stock, but the market had turned against growth stocks because we were worried about the Fed. And that's why the stock ignored the GTC conference, and it fell more than 22% from peak to trough. I mean, come on. That's
the house of pain.
A massive decline. Now, perhaps it was justified. Maybe it wasn't, though. Either way, you can't say NVIDIA never corrected. You can't say it didn't get smashed. In the last few weeks, though, it's come roaring back, but it was hammered. How about Apple? Okay, we don't know if Apple's bottom or not. I mean, stock acted barely today. We do know there's an Apple Developers Conference coming up where we might see a lot of exciting things, including things that make the Vision Pro seem like more of a tool for the enterprise and that spatial computing is for real, at least when it's hooked up to NVIDIA's Omniverse, which is the link to the NVIDIA supercomputer. Apple's quarter was better than feared. Its guidance was better than expected. Its service revenue was terrific. Most important, when I asked Tim Cook whether the next iPhone would have all of the cool AI capabilities that Samsung had, he laughed and assured me not to worry. worry about that. Now, that makes me think that the next iPhone iteration will be a must-buy, which means that you should be buying Apple stock right now. These positives are all ahead of you as a shareholder. It's true that Warren Buffett sold some Apple, suggesting that it might be maybe it was because of the possibilities of capital gains tax rates going higher, but he's still foursquare behind the company and the iPhone. For all of that, what's happened? Apple stock, it fell 17.8% from peak to trough. But like Nvidia, it's bounced back nicely last week. What else? Okay, I don't know what to do with ARM Holdings. This is a terrific semiconductor architecture company taking market share, working arm in arm with Nvidia on CPUs that can cooperate with their ultra-high-speed graphics chips. That's a GPU. GPUs are buffeted by CPUs. From everything I hear, ARM's CPU business is incredibly strong. Yet during this sell-off, this stock fell 48% from peak to trough. It also bottomed a few weeks ago, but it's still well off its highs. It reports Wednesday. It's true that AMD didn't raise its forecast enough for next year's ultra-fast graphics chips that they think can rival Nvidia's. They took numbers up to about $4 billion from $3.5 billion that they were projecting in January, but Wall Street already wanted at least $5 billion or even more. I think analysts got ahead of themselves. The stock during this period pulled back 38% from peak to trough. Now it's starting to rebound. It's only up $14 from its lows. That could be an opportunity. Not that long ago, Salesforce, CRM, gave a terrific quarter, nice top and bottom line beat. They also threw in a dividend and buying back stock enough to keep the float flat. It was an almost universally applauded quarter. And what happened? Well, the stock fell 16% from peak to trough. It's still just a few bucks away from its lows. Bargain. Microsoft blew away the numbers and gave you a great forecast for Azure. That's their fast-growing cloud business. Amy Hood, the CFO, was as ebullient as I have ever heard her. Ever. Many thought the stock was headed to the stratosphere, and initially it did rally hard. But March and April, what happened? Well, the stock fell 10% from peak to trough before finally getting its groove back a week ago. But that's a big decline for Microsoft. Of course, you can say, wait a second, Jim's cherry-picking these declines in tech. I am literally looking at what were some of the considered the great growth stocks of the year that the market changed its stripes on in early March. I got tons of stocks that are enterprise software that just were obliterated. I'm not going into those. In the end, we had a rough time going to the Fed meeting, a rough time going through earnings season, and we were anything but unscathed. There were some huge losses racked up, ones that easily could have made people head for the hills and avoid the whole asset class. If you bought Nvidia at the time of the GTC conference when we were out there, a seemingly reasonable moment to pull the trigger, even as we urge you not to, then you know what happened? You got your head handed to you. And you only made back after some of the losses after today's 4% rebound. If you bought Apple in mid-December at almost 200 and watch it go to 165, well, you probably took a serious loss. Now it's back to 181. Hey, let's not forget Meta. It fell 10.5% on earnings. Intraday is down even more. It didn't stop after that. From its peak to its trough, Meta, okay, this was a very, very good growth stock. It fell 18.5%. Not many people can handle that kind of loss. Talk about shaking out the weak hands, which is exactly what a correction does. And what a hammering. And yet here it comes again. The bottom line, I think the sell-off could finally be over. No one ever wants to say that because then you run the videotape and you look like a joker. I don't care. I have to deal with the prices that I'm dealt with. There could be some bad news ahead, or at least some planned news, though, that we can't expect from the Fed. I don't know. I mean, maybe, maybe not. Forget the Fed for a second. Here's what we have. We have benign earnings reports for a bit. But the most important takeaway, stop waiting for a correction to give you better buying opportunities. We just had one, for heaven's sake. Let's go to Ann in Indiana. Ann.
Hey, Jim. Thanks for taking my call.
Thank you.
Member of the club. Love the piece over the weekend, whether to battle or cut our losses.
Thank you.
So anyway, after Nucor reported, I started a new position. What do you think?
Nucor had some bad news today about there's a particular, they make many different kinds of steel. And one of their kinds of steel did have a decline in price, and people are saying that that's very bad for the company. I like Nucor very much. You are going to have to deal with a bit of turbulence here as it comes down, but I'm leaning toward buying it, not selling it. And thank you for being a member of the club and for reading that very long piece that took me entire Saturday because my kids were coming over Sunday. I wanted to be with them. Let's go to Matt in New York. Matt.
Thank you for taking my call, Jim.
Thank you, Matt.
What are your thoughts on SoFi post-earnings, and can you get the Cramer army, the Reddit army, to buy up every single share of SoFi stock that is out there?
Well, okay, SoFi reported a good quarter, but nobody cares. And, I can defend a stock for so long. And I've now defended this stock for about almost 2 years, about a year and a half. And I think it's okay. But I am not going to sit here and forever say it's okay. So here's what I have to say. I wouldn't buy it. I'd like to see the stock go up. But Anthony Noto is a terrific guy. But I just don't know what drives this stock higher. I just don't know. Let's go to Frank in New York. Frank.
Hey, Frank. Hey, Jim. How you doing, you workaholic? I love you.
Thank you, Frank. Thank you.
I've been watching the stock since it went public recently, and I'm wondering if it could, in some way, shape, or form, follow a little bit in Chipotle's footsteps, Cava Group.
Yes, I think it can. Cava can. And I'll tell you what. Because Cava has that Mediterranean diet going for it that is very good for you. And that's what people want when there's a whole cohort of people, that's all they want. They want to eat out and feel good and be good, and Cava fits that depiction. All right, I am urging you to stop waiting for correction to give you better buying opportunities, because we just had one, as I just demonstrated. And I think we may be closer to the end of the sell-off. Doesn't mean we're done, but it does mean you buy them if they come in. Anybody tonight? This ain't Texas, it's the New York Stock Exchange. But I'm still laying my cards down on Texas Roadhouse to see if the restaurant chain could be appetizing in this tape. Then, is it finally safe to dip your toe back into the market? I'm going off the charts to see if what I just said at the top of this show could be for real. And the pandemic has changed the freight and logistics business. I'm checking in with ArcBest to see whether that is the time to buy a tattered stock. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Last week, we spent a lot of time talking about restaurant earnings because we're seeing a big divide between the winners and losers in the group. It's pretty fascinating. But you know what? I never got around to the best restaurant quarter of all. Yes, Texas Roadhouse, which reported a beautiful quarter last Thursday night. They sent the stock up 3.6% on Friday and then another 2.5% today. That's a good one. Tonight, I want to put a spotlight on this one because Texas Roadhouse has delivered a series of great results despite being in the full-service space at a time when quick-serve outfits have generally been the winners. This thing's been roaring, though, climbing from less than $100 late last October to $167 and change today. People don't talk about it because it's not in New York City, I guess. I don't know. So let me walk you through what makes this story so compelling, because it is textbook. Texas Roadhouse has nearly 700 locations, with 45 locations for Bubba's 33, think burgers, pizza, wings, and beer, and 11 stores for its new fast casual concept, Jaggers. The vast majority are company-owned, giving them more control over everything from menu pricing to staff levels. That's kind of like Chipotle. They pay extremely generous bonuses for restaurant-level managers who deliver good results. Put it all together, and the stock's been a fabulous growth story ever since it came public way back in 2004, but nobody talks about it. For me, the most impressive thing about Texas Roadhouse is that the stock's been a juggernaut lately, even as most full-service chains have struggled. How do they do it? Okay, simple. Texas Roadhouse has figured out how to offer high-quality food, including steaks, at reasonable prices, creating one of the most compelling value propositions for consumers in the whole full-service dining category. Now, we know that lower-end consumers are pretty cash-strapped, right now? And this earnings season, we found out that the restaurants that can do well are the ones that give people a good meal at a good price. That's the common thread we've seen from some of the strongest reports, like Domino's Pizza or Brinker International, Wingstop. Others that raise prices too aggressively without a clear value proposition, here I'm including McDonald's and, yes, Starbucks, are now suffering from traffic declines as customers vote with their feet. There's one exception to this theme, though, which is Chipotle, which has raised prices aggressively, particularly in California because of that minimum wage issue, yet has seen no deterioration in demand at all. Wow. Now, Texas Roadhouse, on the other hand, has followed the more typical blueprint for what works. The stock actually bottomed in late October after the company reported a big earnings miss, their third earnings miss in 4 quarters. Not good. But Texas Roadhouse rallied in response because Wall Street was focused on their terrific revenue momentum. In late October, they delivered 8.2% same-store sales growth. Wall Street was only looking for 7.5%. Even as the rest of the industry was starting to lose steam, on the traffic at least, Texas Roadhouse never did. To put it another way, last year the restaurants were still dealing with plenty of inflationary cost pressures, and many decided to raise prices in order to pass those customers on to you. Texas Roadhouse did take some price, but they were much more measured with their price hikes because they really care about giving people good value for their money. That decision hurt their earnings in 2023, but the strong same-store sales showed that the customers liked it. They had a little more vision. Ever since the stock bottomed in late October, the company's reported 2 more quarters, one in February and one last Thursday. And on both occasions, they made real progress on getting costs under control while continuing to deliver fantastic same-store sales. In short, it's all coming together for this Texas Roadhouse. Now, they didn't raise prices aggressively when the rest of the industry was doing that. And now the customer base is rewarding them for it. Now, doesn't this make sense, right? They didn't raise the prices. People went there. The other guys raised prices. They stopped going to them. When Texas Roadhouse reported in February, it had a 10.1% comp restaurant sales growth. That's incredible. That was for the full year, with more than half of that increase coming from traffic improvements, more people. When you add in the company's steady new store growth, their total revenue grew 15.4% last year. And for all the hand-wringing about the earnings misses, Texas Roadhouse still saw its earnings per share grow by 14.3% last year. Management's initial guidance for 2024 included calls for positive same-store sales growth and store week growth of roughly 8%. Store week growth is a quirky metric that accounts for new locations. At the same time, they talked about mid-single-digit commodity cost inflation and labor inflation. Put it all together, and the stock jumped 10% in response. The numbers were just that good. Fast forward to last Thursday night, Texas Roadhouse reported yet another blowout. This time they had 8.4% same-store sales growth. Wall Street was looking for 7.8%. Some of the best comps we've seen from many major restaurant chain this earnings season. CEO Jerry Morgan noted that strong traffic trends continue to drive sales growth. Crucially, Texas Roadhouse modest price increases have taken effect just as some of the cost inflation is fading away. The restaurant margin came in at 17.4%, up 150 basis points year over year, and 50 basis points above what the analysts expected. That's sensational. Even better, Texas Roadhouse gave us some bullish updates on the full year. First, management disclosed that through the first 5 weeks of the current quarter, same-store sales were up 9.3%. So you got a meaningful acceleration versus the first quarter. For the full year, they also lowered their commodity inflation, cutting it from 5% to 3%. What a story. So to recap, Texas Roadhouse looks on track to deliver, I would say, much better than expected same-store sales. And while the cost inflation will likely be lower than expected, that's such a combination. It's ideal, and it's why the stock's rallied so strongly in response to the latest quarter. Now, in the conference call, CEO Jerry Morgan put things pretty simply. He said, quote, "Our strong results continue to reflect our operators' commitment to the consistency and quality of the food, the hospitality they provide, and our everyday value. The benefit of our long-term approach to the business and our focus on always prioritizing the guest experience is evident in the record sales, margin dollars, and net income for the first quarter," end quote. See, this is a great story. This is how it's supposed to work. You don't take the price. You don't gouge the people. You end up getting more people to come. You can take price a little bit, and then the costs go down. This is what business is about. So despite the fact that Texas Roadhouse operates in one of the more challenged subsectors of the restaurant industry, the full-service space, I think it deserves to be in the upper echelon of restaurant stocks right now. This has been a long, great growth story, but right now in particular, Texas Roadhouse is killing it because they never drove the customer base away with aggressive price increases, as we know some have, making them a rarity in the restaurant space, one they can clean up now that cost pressures are fading away. Of course, after the latest one, the stocks are up 37% year to date, and up here it's quite expensive, 28 times this year's earnings estimate. But I like it. Bottom line, if you buy Texas Roadhouse stock at these levels, you're chasing it, I admit. So I think maybe it would be great if you were patient, maybe the stock cools off a little before you start a position. But if you can't resist it after what I just told you, you know what? You got my blessing, because this is one terrific story. Net Money's back after the break.
Coming up, the charts may be signaling a key move, and it could happen this week. Take a walk on the technical side when we return.
Has the market truly changed its stripes? Was I too bullish at the top of the show? I think that's the question that we got to figure out. Last week, we got an extremely benign Fed meeting, right, where Fed Chief Jay Powell made it clear that he has no plans to start fighting the bulls again. And then 2 days later, we got this cooler than expected labor report. For months beforehand, Wall Street was terrified that the economy was overheating and the Fed might need to lower the boom on us again, hurting the stock market, totally wrecking Jay Powell's credibility, too, because he had indicated the rate hikes were over. That's why I spent so much time lately highlighting the brown shoots. Newfound signs of a slowing economy, because a slowdown is what gets the Fed off our backs permanently, allows the stock market to rally like it did today. Last week, the Fed recognized those brown shoots, and then 2 days later, we got the ultimate brown shoot. That was a sign of a slowdown in hiring from the non-farm labor report. Ever since last Wednesday, Fed's meeting, this market has caught fire again after spending most of March and April really kind of in the dumps. So, can the averages keep running? This feels like a decisive moment, doesn't it? One where we might shift from the early spring sell-off back into rally mode. At moments like these, you know what I like. Do I take my emotions out of the equation and consult the technicals? And that's why tonight we're going off the charts with the help of Carolyn Baroden. She's that brilliant technician who runs a trading room at ElliottWaveTrader.net and whose work you can find on X, formerly Twitter, at Queen of Fibs. Do you know that she predicted a period of turbulence for the market back at the end of February, pointing out the S&P 500 had gotten overextended? And she told us that the turbulence would be temporary, but she acknowledged it could be pretty painful. I said at the top of the show that it has been. Now, has the turbulence truly come to an end? Why don't we take a look at the weekly chart of the S&P 500? Broden's always searching for price points or dates where security is most likely to change course. For example, she likes to look for what's known as signs of symmetry. These are moves that tend to be surprisingly similar to previous swings. You'd be surprised how often this happens, where a decline terminates after roughly the same amount of points as the previous decline. I can't tell how this dynamic exists. I just know it seems to show up in the charts all the time, making it a pretty reliable pattern, frankly. Technical analysis is all about predicting human behavior, and people seem to like buying stocks or indices after they pull back by roughly the same amount as a previous decline, which is why the concept of symmetry can help predict sustainable bottoms. In terms of the S&P 500, when you look at recent declines, they lasted for about 315 to 336 points. When you look at its latest low in mid-April, the S&P was down 311 points. And you can see these. I'm going to show you one that's over here that's really interesting. But this was a 311-point decline, all right? That's very similar in scale to one of the previous pullbacks. Now, that was the 315 decline. Since that low was made, Baroden points out that she's seen multiple buy signals on the S&P daily and intraday charts. Remember, she loves to watch the 5-day exponential moving average, the 13-day exponential moving average on the daily chart. When the 5-day goes over the 13-day, that is her buy trigger. She also looks at a half-hour chart where each tick represents 30 minutes, where she uses the 5-period exponential moving average and the 34-period moving average. After April, the 5-period moving average has crossed above the 13-period. May is the time to buy, okay? So far, the S&P rallied about 210 points off its new floor of support. As long as it holds above its April low, which come in at the mid-4900s, Baroden would not be surprised at all if the S&P can keep running. Either way, this chart's painting a much more bullish picture than we've had for quite a long time. But it might not be totally smooth sailing on the way up. Just zoom in on the S&P 500. Now we're going to go to the daily chart. Now get this. Baroden points out the S&P is now jousting with some very important resistance levels. As she sees it, we just cleared a major hurdle today, and this is, I'm going to mark for what happened today at the close. We just cleared that hurdle, and she thinks that that can mean that we can move to 5349 on the S&P. That's up a little less than 170 points versus where we are right now. She says the next major hurdle comes at 5457. All right, so we're going to have to hit this all the way. Now we're talking about way up there, all right? And if we clear that hurdle, then she thinks we can hit 5638. I didn't even bother to put those on. Like, let's deal with the hand we've got here. Now, how does she identify these key price levels? Well, Baroden likes to measure past swings and then run them through what's known as the prism of Fibonacci numbers, which are these series of extremely important ratios that show up everywhere in nature. The patterns of snail shells, the layout of flowers or pine cones, or even, I found out, cauliflower. Yeah. And also the stock market. Again, this is one of those things with no clear logical explanation. I don't have one. But we know the Fibonacci patterns are meaningful because they repeatedly show up at major pivotal points for individual stocks and for the whole market. When it comes to the S&P 500 right now, Baroden sees a cluster of Fibonacci levels running between 5143 and 5161. Okay, you see these? Thanks to today's bullish action, we've now cleared each of these levels, and all day we were checking in because remember, we're updating. These are not easy things to do, and we're clear. And we kept hearing, yes, we're clearing, and she believes that therefore we have the potential for a new high, and it's got a lot more likely after today's action. These key levels come from the coincidence of the 100% projections of a previous swings, a 161.8% Fibonacci extension of a previous move, and another 127.2 extension of a different move. Again, these are all part of the same mathematical construct. We've also got a 61.8 retracement and a 78.6% retracement in there. I could go on and on about these. I just need you to know that we're taking out very key levels that signify strength. Right now, it's looking like the S&P has cleared each of these possible ceilings of resistance, meaning it could be smooth sailing, assuming we don't give up these gains tomorrow. Basically, Broden thinks this was a make-or-break moment for the market, and right now, it feels like we're going to make it. As long as the S&P doesn't backslide much from here, she says that it's likely headed for 5282 or 5349 from the weekly chart remaining on the table, and that would be sensational. Let me give you the bottom line. Again, I can't emphasize enough how many times we're back and forth trying to get this right for you. The charts as interpreted by Carolyn Broden suggest that this could be a decisive week for the S&P 500, and after today's run, she thinks it's looking very much like it's going the way of the bulls. My view, look, last week I thought was a game changer. We were afraid we'd have to fight the Fed again. Now it's clear the Fed doesn't need to tighten, and as long as the economy keeps slowing, we might even get a rate cut or two, because practically everyone's given up on getting any sort of that kind of relief. For me, that jives with Broden's reading of the charts, and I like it. Dave in Florida. Dave.
Yeah, hi, Jim. Booyah.
Booyah, Dave.
How you doing?
I am doing well. How about you?
I'm doing good. Doing good. Thank you. My question is about Pfizer. I chose that as a holding when COVID-19 broke out versus Moderna during the Operation Warp Speed.
Right.
Is Pfizer going to be a sleeper or
I think Pfizer's bottoming. I think that that CGen is starting to kick in. I think they're doing a lot of stuff, by the way, with migraine, which makes me very happy, being the spokesperson for the American Migraine Foundation. I think I don't want to call it a new Pfizer. I want to call it an energized Pfizer, and I think you're going to see some good things. In the meantime, you got a 5.9% yield, so I like it. Jim in New York. Jim.
Hi, Jim. How you doing?
I'm doing well, Jim. How about you?
Oh, I'm doing great. Thanks for taking my question.
Quite welcome.
Okay, since mid-March, Linde's stock price has fallen 10%, and about half of that decrease coming since the first quarter results were announced on May 2nd. Do you think this reduction is reasonable in light of Linde's performance, or do you think the market has overreacted?
Well, Jeff Marks and I went over, I'll tell you, we went over every single line over and over again. We think it is business as usual, that there are some people who felt that Linde would be hurt by the fact that people are not as concerned about the environment as they are about security right now. I think that's short-term nature thinking, and you should hold on to the stock, and that's what we told club members. All right. The charts as interpreted by Carolyn Broden suggest that this could be a decisive week for the S&P 500. After today's run, she is actually getting more bullish. I don't blame her. We saw why. I think there's a lot. I think that it's a reasonably good level. Now, as much more made money, including my exclusive with ArcBest, we are always on the lookout for signs that the Fed rate could cut rates. What would it mean for the freight industry? Typically, it's pretty good things. I'm checking with the CEO. Then the big retailers haven't reported yet, but the smaller ones and some restaurants are sending us some signals that we have to listen to. I'll share what we've learned and how it could impact your earnings season investment thesis. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Lately, we've been looking for what I call brown shoots for signs of a real economic slowdown, because that's the only way that the Fed stays our friends. I mean, look what we saw last week, right? How good is it that the Fed's on our side? And you know what? We've seen a ton of brown shoots from the freight business. Take ArcBest, which is a really well-run logistics company focused on less than truckload freight and managed transportation solutions for the enterprise. Last week, ArcBest reported, while their revenue came in a little higher than expected, they only earned $1.34 per share. Wall Street was looking for $1.53. All right, that wouldn't have been too bad, but on the conference call, management did have some discouraging things to say about the freight business in the month of April. And that's why I believe that the stock plunged more than 14% on the news, but that's just my reaction. Was that an overreaction, or is the business truly deteriorated that badly? Let's check in with Judy McReynolds. She's the chair, president, and CEO of ArcBest to get a better read of the situation. Ms. McReynolds, welcome to Mad Money.
Well, thank you, Jim. How are you?
I am good, Judy. How about you?
Doing well.
Okay, I need to know, we've had a sell-off, and the sell-off has been pretty severe. Tell me if it's warranted or not, please.
Well, I don't believe it is. We had a great quarter from an execution standpoint, although we were impacted, as the industry was, by the soft environment. And so when I look at the quarter, I see that we overcame the soft demand and a $29 million increase in labor costs, and produced results that were equal to last year in terms of the asset-based operating income, which was executed well. And that was accomplished by the optimized work that we were doing with our costs and some specific cost-cutting measures.
Okay.
Go
ahead. No, I'd like to, because I was going to ask you about the cost cuts, because the operating ratio was not what I want, but you are a union operator. It's not easy to go up there against J.B. Hunt. It's just not easy.
Well, I feel like that the labor cost deal that we entered into last summer was effective, and it was certainly front-loaded. But overall, for the 5-year period, it's about a 4% cost increase, which is pretty reasonable. And so, but we did deal with the front-loaded nature of that in the first quarter. But the great news is we were able to, optimize our costs in other areas and really select freight that was good for us, grow our core business, and it worked very well. Our strategy is to accelerate our growth, increase efficiency, and drive innovation. And one of the innovations is the optimization of our city routes, which enabled us to reduce miles and reduced our costs by about $12 million on an annual basis. And we also saw an increase in our pipeline for customer growth of 35% since the beginning of the year. And we were able to drive innovation as well through the announcement of Vox Smart Autonomy. This was Time's Best Inventions last year. And it was also a good quarter from progress on that from pilot customers. We're piloting that work with the Fortune 50 and Fortune 500, and we have about 20 pilots in place. So I was pleased with the execution in the quarter. Certainly was a softer demand environment, but we made a lot of progress on some longer term issues, which is the way we think.
Well, okay, so the softer demand environment, does that continue? And I pointed out because, you've got a Fed that has been saying until last Wednesday, higher for longer. And yet when I looked at the projections of how you guys have done, you're a pretty good barometer of the U.S. economy. I could not understand why he would keep things higher for longer, given the numbers that you have.
Well, it has been an interesting difference, I think, in the overall economy versus the freight on trucks that we're seeing. But, when we think about it, we know that the demand environment will be unpredictable. But what gives me confidence in our business is that we know that customers need to make their costs more efficient, and they want reliability, and we deliver those solutions. Our managed solution, which is designed to help customers plan, execute, and optimize their supply chains, had double-digit growth in the first quarter. And the momentum and the pipeline there is really good. And what's interesting is when you think back about the pandemic, our customers were wanting capacity sources. And they also wanted flexibility to deal with some of the pain points that they had, like parts shortages and other things. And we were able to deliver on that as well. So the way that we built this integrated logistics platform is just effective in this variety of environments that we're facing. So, we're confident about how we're positioned and how we're serving customers, and that's working very well.
Does it bother you that probably what would get the stock going is not necessarily how you're doing, but if the Fed cut rates? I've always wanted to ask someone in the industry, just saying, look, here you are, you're working so hard, you're trying to do everything right, but a quarter point rate cut is what would move your stock up 20 points, isn't it?
Well, it's certainly a possibility, but we just deal with what we can control. Right. And we try to address that in the short term, which I think our team does a great job of executing. We had, the best service performance in 3 years in the first quarter. That's an example of that. We received accolades from ATA for the Excellence in Security Award in the first quarter, which is something that customers look to and trust us for. So those are the kinds of examples of things that we can do well despite what's going on in the macro. And that's where we like to spend our time.
Well, I think that's absolutely right. And it's why you can, that's the investment case. You're doing those things while we're waiting for the Fed, and that will really help your ultimately your traffic. Well, anyway, I want to thank Judy McReynolds. She's the chairman, president, and CEO of ArcBest. Thank you, Judy. That's a great explanation of where we are right now.
Thank you so much, Jim.
Absolutely.
Enjoyed being with you.
Okay, Mad Money's back after the break.
When we return, master the markets one stock at a time. The lightning round is up next.
It is time. It's time for the lightning round. Quick, CNBC stocks that are buy, sell, don't know the course. I'm going to plan to sell. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Let's go with Max in New York. Max.
Booyah, Jim.
Booyah, Max. What's going on?
Wanted to know about AeroVironment, ticker AVAV.
Absolutely. And here's what you need to know. We have a lot of very expensive military equipment that is just way, way too expensive. And then we've got the stuff that AeroVironment makes, and that's the bargain. And it's about time that the Pentagon started looking at the guys who don't cost us an arm and a leg, because our enemies have very inexpensive drones. We can have them too. Let's go to Craig in California. Craig.
Is this the Chillmaster J?
You bet it is. What's going on, Chief?
Hey, yeah, I'm looking at a stock. I don't have any exposure in this one sector. Seems it's got a nice dividend, dirt cheap PEG ratio, revenue growth over 26% over a 3-year CAGR, with gold seemingly destined for $2,500 an ounce. Is it time to stake a claim in AEM, Agnico Eagle Mine?
I think that Sean Boyd's been delivering since he's been on the show. He's got a really good hand, and he's been playing it. And I like the gold stocks, and I do like gold very much here. How about Jordan in Florida? Jordan.
Jimbo, booyah!
Yo-ho, man, what's happening?
First-time caller, long-time listener.
There we go.
Philly guy here. Moved to Florida about 30 years ago, where I met my beautiful wife and grew my family.
Lucky man.
Couple questions for you, buddy.
Sure.
First, before we get into business, a little sad note on the Sixers. Feeling bad about the Sixers.
Remember, Philly is a football. Philly's a football town.
Birds this upcoming year.
You bet. Howie Roseman knows how to do it. All right, Howie Roseman knows how to do it. All right, let's go to work.
Okay, back to biz. I'm calling about Nutanix.
Well, Nutanix is a perfect enterprise software company for the moment because it's cloud enterprise software, and that's what people want. It's very expensive, but it's going to keep going higher, I think. How about Chapa in Florida? Chapa.
Hey, Jim, how are you?
I am good. How about you?
I'm good. Hey, so
okay.
The stock I'm looking at is Altimmune. A few weeks ago, you labeled it spec. I'm wondering if you changed your mind at all on it.
Well, no, but, it's not bad that it's spec. I'm literally saying that it's one of those situations, because it's not making any money and losing a lot of money, that you have to expect the fact that if one of its drugs fails, it is going to get hit. That's a definition of spec for me. Not that it's a bad company, but that it's much higher risk than a company that has continual earnings streams. And that's exactly how I still feel about it. Let's go to David in Missouri. David.
Hey, Jim, how you doing?
I'm doing great. Well, good.
We're club members, and I'm a first-time caller, and we appreciate what you do for the little guy.
Thank you, man. I hope you like my piece this weekend. Spent a lot of time on it.
Right. Hey, we're calling about CVI Energy.
Yeah, this is a refiner of a lot of the different chemicals that my friend Rusty Brazil writes about all the time. I think that the cycle could be turning against them. I'm feeling that way because of when we had Agco on, and I am concerned that dividend is going to prove to be a value trap. Let's be very careful, CVR. How about Jared in Washington? Jared.
Jimbo Slice, booyah.
Yeah, man, what's up?
Jim, you guys reported another great quarter last week, and with Berkshire's latest comments on the capital about to hit the utility sector in the next 5 to 10 years, these guys do it all, man. What do you think of Quanta?
Oh, my God, they're so good. Isn't it incredible? Quanta's just such a terrific company, and I always say, let's get in there, and we don't. And let's end that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up A latte, a burger, and some can't-miss consumer clues? Food for thought on the earnings front when Mad Money returns.
The big retailers haven't reported yet, but the smaller ones have already taught us an important lesson. If you're trying to get away with maintaining high prices here, you're going to lose customers. Very few operators are ever willing to admit their prices are just too darn high. If you acknowledge it without doing anything about it, you're setting yourself up for disappointing numbers going forward. Buy! No. It's not easy to figure out who can get away with keeping prices higher. Chipotle pulled it off because customers think it's worth it, something you hardly ever see. We heard Brinker, the parent of Chili's, tell us about the success they've had with what they call a barbell strategy, offering lower price items for more value-conscious consumers and premium items for more affluent customers. Kudos to CEO Kevin Hochman for not making an either-or proposition. That was a good idea. His stock keeps going higher. Now, Yum stock got hit because it wasn't because of Taco Bell. They offered some outrageously cheap food. The Cravings Value Meal with 10 items under $3, that looks like it did great. Some of the other divisions, not as good. But McDonald's failed the test because, in my opinion, the burgers now cost too much. They've just gone up in price so much since 2019, so they don't come off as a bargain, something that the home office has to know. But the franchisees seem reluctant to admit. I know Starbucks disappointed and their coffee might be too expensive, which is saying something because it was always pretty expensive. But nobody seems willing to own that idea. There's disappointment all around, including from former CEO Howard Schultz, not on the board, though. I'm not hearing anyone talk about rolling back prices at Starbucks. They just seem to want to add more menu items, which I think would actually lead to worse throughput. Another unacknowledged problem among many. Owning this one for the Travel Trust has been nothing short of a brutal experience. What else? Okay, this morning, Tyson Foods said its prepared food business, which has seen 20% cumulative inflation over the last 3 years, has now become too pricey for many Americans, causing the company to struggle with its earnings. That's why that one was hit. So what does all of this tell us as we head into retail earnings season? I think the takeaway is that Americans want what Walmart and Costco give them, a very low price that rolls back their own house brands to levels that feel like bargains again. Walmart's created a new version of its own brands that offers less expensive prices. Costco has always been a bargain. I think both will do well. Now, I'm not sure how the market will react to Target, Macy's, or Nordstrom. Target has those terrific house brands. They have billions of dollars they sell, but they do offer real value. But I don't know if that's enough given how much the stock is run. That said, Target yields almost 3%. I bet it'll be viewed as enough of a bargain that people will be drawn to it. Nordstrom flirted with the idea of going private, but I wonder whether it has the cash flow to get a deal done. Macy's, I find, is the most intriguing. They've added 2 board members at the suggestion of a suitor, Arcast. The question is, does that end a possible $24 takeover bid that had been widely talked about? You know, it's really not clear. But I do know this. If it weren't for the activists muddying the story, I think the company has made a case for affordable luxury with Bloomingdale's and current CEO Tony Spring, who hails from the Bloomingdale's division. I'm guessing Macy's will be given some time here to work some magic. Last are the 2 dollar stores. They're very confusing, Dollar Tree and Dollar General. These 2 are known for lower prices, but will people think they're as cheap as the prices at Walmart or Costco? Is the price of Costco's membership too high for the dollar store shoppers? That's what I'm thinking. Well, anyway, it nets out to be cheaper if you can afford the upfront payment, believe me. Hey, you know what? So does Walmart. But the dollar stores are always able to offer something that can match or exceed Walmart when it comes to lower prices on individual items. Hey, here's a real oddity. Williams-Sonoma reported excellent numbers, and it's certainly not the cheapest in its category. That's Wayfair. But like Chipotle, Williams-Sonoma is regarded as a high-quality brand, and that's what people want. In the end, I think retail's still the ugly duckling versus travel and leisure. People don't want to spend money on physical items unless they have to. But even then, they're going to be more frugal, even if it means getting a lower quality hamburger or a latte. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.